Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. When managing their clients' investments, a financial advisor has a lot has several different decisions to make when they're managing their clients' investments. Among the decisions are whether they should use actively managed investments, make sure that asset allocation is diversified enough, while helping their clients understand some investing concepts. Well, I have on an industry expert to share his insights on these topics and much, much more. But first, today's episode is sponsored by the award winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. All right, let's go ahead and get started and move on to the star of the show. I am honored and very excited to welcome Barry Mandinach. Barry is Executive Vice President, Head of Distribution at Virtus Investment Partners. Barry, thank you so much for coming on the show. It's really an honor to have you on. I'm excited for this conversation. Can you please tell us a little bit more about yourself and Virtus Investment Partners?
Sure. Thanks, Ryan, and it's great to be here. In terms of me, I've been in the business since the early 80s, started at Drexel Burnham, and was involved in the legal side of the business, working on prospectuses for private placements and so forth. And then moved into the mutual fund world. And then Marty Zweig, Gene Glazer, and myself ended up buying the mutual funds from Drexel, the Drexel funds,
Okay.
and creating the Zweig Mutual Fund Complex, dedicated to tactical asset allocation. That was in 1989. And then we sold that and I joined Phoenix Investment Partners in May of 99. I was there for a couple of years, and then joined UBS Asset Management. I was there for about 14 years. And then joined Virtus about 11 years ago. Virtus being a public company and a spin out from Phoenix Investment Partners.
Okay.
So a long career in asset management, focused mostly on the wholesale side of the business, the FA or intermediary side of the business, although also overseeing and working on the institutional side as well. And as it relates to Virtus, Virtus is a public company, multi-manager boutique. We manage about $167.5 billion. What we do is buy interests in specific boutique managers that have particular investment specialties. We like to think of ourselves as providers of differentiated, distinguished, essential building blocks to a well-diversified portfolio. So we have a wide range of capabilities, from equities to fixed income to alternatives, across a wide array of vehicles, from ETFs to mutual funds to managed accounts, and private placements. And that's a quick overview of who we are.
Fantastic, Barry. Thank you for that. Over the past couple of years, I've had the privilege of talking with some of your affiliated firms, asset management firms, and their folks, and you've got a great lineup there, a lot of great thought leaders, portfolio managers. So you're doing well, and I've really enjoyed talking to a lot of those thought leaders and folks on your team. Let's go back to you handling the prospectuses years ago. How fun was that, huh? I mean,
I
great
didn't
fun
realize,
reading a prospectus. I can't imagine putting one together.
I didn't realize until recently that it was 1981 and it was a recession. So I was looking for a legal job. I had just graduated law school and taken the New York bar, and Drexel had an opening and I took it. And what was interesting was everything that you wanted to include from a marketing perspective had to be included in the prospectus. So I was effectively writing marketing material in the prospectus, then ended up teaching salespeople how to leverage the prospectus from a sales and marketing perspective. And before you know it, I was really moved over towards distribution and away from legal. So it was a good thing.
Yeah, that is interesting how you didn't think about it at the time, but how that experience really has benefited you now
Yeah.
in your role through the years. Interesting.
Many of my lawyer friends are jealous that their career did not take similar winds and paths to get out of the legal.
I bet. I bet. You talked about, finding managers and asset managers that that have a differentiated product or strategy investment philosophy in their active management. For years there's always been this active versus passive debate. That line between the two is blurred a lot recently compared to what was 20 years ago. And a lot recently due to the growth of active ETFs. Is your take on the active versus passive management debate, and how has it evolved recently?
So I think there's a place for differentiated active as opposed to just average active or generic active. And I think most portfolios have room for both under the hood, if you will. The
Mhm.
objective for most advisors is to build a portfolio that is designed to pursue returns that their clients need over time, but do it in a manner that doesn't ask that client to be somebody they're incapable of being. So a modicum of volatility management has to be part of the value proposition, putting together a truly diverse portfolio. And when most people think about diversification, they think of stocks, bonds, and cash, or domestic and international, or large cap and small cap. I would suggest that diversification should also include a proper mix of uh, low cost passive exposures in appropriate asset classes with differentiated active managers. The question is, what constitutes a differentiated active manager? And while there's a lot of ways you can look at it, my preferred way to look at it is a manager that has delivered superior risk-adjusted returns over market cycles. So another way to say it is smoother ride access to an otherwise volatile asset class that serves as an essential building block to a well-diversified portfolio. Does that make sense?
That is fantastic, Barry. I think that's great, and it's interesting. I love how you just started that response with, for a financial advisor, it's about building a diversified portfolio that you know aligns with the client and make sure the client is who they are, right? They're not trying to be somebody who they're not. And it sounds simple. It sounds simpler than what it is, but it's a great way of putting it.
Ryan, in my experience, and I've been doing this for a while, you take a retired person or a nearly retired person, most of them don't have the capacity to look at a 30% decline as a temporary fluctuation or as a buying opportunity. They see it as a more fundamental issue they need to address and confront. And so long as that's the case, then, stocks, bonds, alternatives, cash all play a role. But I also come back to differentiated active because another way to think of passive, while it's a very tax efficient, cost effective way to get exposure to an asset class, you also have to look at it honestly and say it requires you to ride the market 100% of the way down in order to capture 100% of the ups over time. Uh, Not everybody has the capacity to ride the markets 100% down, and others would like to pursue better than market returns over market cycles. So in some ways, I think of passive and I say it's kind of valuation agnostic at a time when valuations are elevated by most historic metrics. Okay.
Mhm.
It's quality agnostic at a time where there's a lot of global instability going on and people are concerned about things. So It's about having an honest conversation about the pluses. There are a lot of benefits to passive that should never be dismissed. But there are some drawbacks too, just like there are drawbacks with active and differentiated.
Yeah.
But you gotta be, gotta find the right mix for the right clients so that they can take on a portfolio that they can stick with thick and
Yeah.
thin.
I'm glad you brought that up, Barry, because over the year, when I started 20 years ago, it was like you're either active or passive, but that is such an old school way of thinking because just like you said, they can work together very well in a portfolio, in fact. And, I've done a lot of research in Zephyr. It shows all the different asset classes, different styles, and where it's hard to beat the benchmark, right? Markets are efficient. There's some styles and asset classes that are more efficient than others. Like large blend, you might be better off just buying an ETF, whereas a small cap, you're probably better off going active, right? So,
That being said, though, Ryan, I'll challenge a little bit on one topic there. Historically, over time, I agree that certain asset classes are much more efficient and much more suitable for meaningful passive allocations. But just take the large cap for holding that
yeah,
SP1 represents. Today you have, thanks to the Max 7, historic concentration risk. Most people don't think about that. And I know great advisors are very concerned with concentration risk and how to get S&P like exposure, but maybe using some other factors, more equal weighting approaches and so forth. So, it's just, there's room for multiple ways, within each asset class to try to extract the best outcomes from companies.
that's a great point. And, I just finished up some research. It's amazing. And you talked about diversification. So, within Zephyr, I created just a very basic global diversified 60/40 portfolio. If you don't rebalance that account from 10 years ago to today, a 20% allocation to large growth, the Russell 1000 large growth, 20% allocation then 10 years ago is now 40% of that portfolio, right?
Uh, it's wild. The last 15 years, actually the last 17 years, have really been quite historic in many ways. And that the S&P has outperformed virtually every asset class by historic magnitude over an extended, like I said, 17-year period. So when large caps outperform mid caps and small caps by wide amounts and consistently over 15, 16, 17 years, when they outperform international developed and emerging markets by similar historic margins, people question the merits of diversification. Why don't I just buy the SPY and get, one-stop global diversification? And, usually, uh, the path of least resistance is often the worst path to take. And so the easiest thing to do, as they say in the short run, is sometimes the worst thing to be doing in the long run.
Yeah.
Uh, so it's a good time to kind of tap the brakes and really think about what you're trying to accomplish. And just another adage, when global diversification is least wanted, it's often most needed. When market cap diversification is often least wanted, it's often most needed.
Yeah.
Same with alternatives. When you have 15% annualized returns on the S&P 500, who hedges risk in a market like that? Who wants to mitigate the downside? Who wants to have low or non-correlated investments? You want to be highly correlated.
Yeah.
We don't. So it's a tough time to be an advisor focused on diversifying, rebalancing, and rebalancing, as we mentioned earlier. I think Peter Lynch said this: it's like cutting the flowers and watering the weeds. You're selling your winners to buy more of your quote losers. It sounds a lot easier to do than it is in practice, but that's why great advisors are so critical to building client outcomes.
Yeah, let's talk about diversification for a little bit here. You're exactly right. Diversification, it was a hard sell for years when, you know, U.S. large caps outperformed everything, and that makes a job for a financial advisor very difficult. Be like, you should invest in international, invest in overseas, invest in fixed income when maybe their friends at the country club were investing in the Meg 7. They invested in Apple, which outperformed. Like, that's a tough sell. But diversification, that shifted, during the first 6 months of 2025. Internationals roared back and outperformed. Fixed income now is very attractive and a total return compared to the US equities. Is it back? Is diversification? Can we move that conversation about diversification is dead? Um, is that yesteryears?
No, I was just reading today that flows into the non-US funds and ETFs, be it international, developed or emerging, for the first time in a long time are surpassing those of US equity flows. So none of us know how the rest of the year or the next 2 years or 3 years will play out. But there seems to be an awakening that for the first time in a long, long time, there's a penalty for having a home bias. Where
Yeah.
the US stocks are 60% of global market cap, they're 80% of US portfolios. Um, and, you know, if the non-US markets continue to outperform and we see a mean regression event like we did from 2000 to 2009, the FA that, kind of counseled their client to take the path of most resistance and diversify, should be well rewarded for them.
Yeah, I agree. And I can't remember who exactly said this. This quote or similar to this quote, but you know, if you're a stock picking is very difficult, and diversification is a hedge against being wrong, right? You can diversify, and I'll tell you, I'm wrong quite a bit. So I'd much rather be diversified than trying to be right maybe
We
50% of
often say here, we don't know, therefore we diversify. It's the ultimate signal of humility, is how little we all know. And the best investors and the best advisors have a great awareness for where they have competitive advantages and where they don't. And one of the most important competitive advantages is to know where you don't have a competitive advantage and stop competing. And one area that I think we all agree is short-term market prognostication, is an area that none of us have expertise in to do it well consistently.
Yeah.
Once you have the ability to recognize that, the more passionate you are around diversification and rebalancing.
Yep, you're exactly right. Diversified portfolio, the 60/40 portfolio, a lot of people, it's dead, or it's evolved, or well, however you want to say it. What does a diversified portfolio look like to you?
Well, I guess this is the lawyer in me saying it depends on the client, right? But to me, it's like I said earlier, there's a mix of stocks, bonds, non-correlated and low correlated investments, and cash.
Mhm.
Uh, then you take it to another level. Within fixed income, there's a mix of credit risk and duration risk, right? Within equities, there's a mix of market caps. Many people think that if they buy large caps and small caps, they automatically have exposure to mid caps. And that's not the case. And mid caps remain one of the most under-owned uh, spots in the market because of that perception. So to me, diversification within equities means large, mid, and small. Mid caps tend to be more proven than many small caps,
Yeah.
established, but have longer potential runway than many large caps. So to not have kind of a purposeful exposure to mid caps is to your detriment. So you want to have market cap diversification, you want to have global diversification, you want to have active passive diversification, and you want to really put a portfolio together again that your clients can stick with thick and
Yeah. I'm glad you brought up mid caps. I just recently had a conversation about a month ago about mid caps and how it's kind of like the forgotten middle child, literally middle child, right? And everyone talks about large caps, small caps, but mid caps of performance, when you look over long term, it stacks up very well to large caps and beats mid small caps. So it's a
It's an
very
asset,
attractive space, like you said, that doesn't get much headlines.
it's an asset class that we at Vertis love very much. We have a number of different managers that play in that space. And for all the reasons we talked about, it's more proven than small, more potential upside, longer runway for growth than some of the gigantic companies out there. So it's a great spot.
Yeah. We talked about the high concentration and select sectors, individual stocks, styles. You said, mentioned earlier about mid cap core. Yes, it's, maybe a good place for passive investors, but when there's a high concentration in a few names, maybe there's some opportunity for active management. How can financial advisors build portfolios to offset that high concentration risk or the risk that's associated with that?
Well, you can look for, there are a number of ETFs and funds out there that seek to address that through marrying equal weighted approaches so that you're not as subject to the 10 largest stocks in the S&P 500 as a market cap weighted traditional S&P index would be. And then you can layer in some factors that you find that consistently work well over time. Not all the time, but over time. We have an offering that does that called Joe T, with Joe Terranova, uh, where he's selecting he's screening the S&P 500 stocks for quality and momentum factors, and then taking the highest rated 125 of those and equally weighting them.
Mhm.
But there are other approaches as well. That's one of the ways we address it. So, and just making sure that all of your U.S. equity assets, as great as UI has done for the last 15 years, you want to make sure that you have that diversification on the market cap spectrum, perhaps on the growth and value spectrum. If you're not going growth and value, I advise always using core approaches. That's the way to do it.
Yeah. Let's go back. You mentioned about the differentiated approach to active management versus maybe the average active, which I thought is very interesting. We often talk here at Zephyr about using tracking error to uncover some active managers that maybe are closet index funds. Why are you paying that extra fee for active manager who's
Yeah.
behaving passively? Are there any other ways where a financial advisor can maybe uncover some of those funds and really find a truly differentiated active manager?
Great topic. And there are a number of ways that I personally like to look at. One of my favorites is upside downside capture ratios, uh, because I believe that behavior drives outcome and the ride matters, right? So a manager that requires you to, take on 120% of the downside to get 130% of the upside, that may be asking too much of a lot of people. So I look for managers that have given me more than 100% of the upside over time. When I say over time, over market cycles, and done so with market downside captures of below 100, preferably considerably below 100. That's so-called smoother ride. So that's to me my favorite way. That usually translates into an attractive rank on Sharpe ratio as a good risk-adjusted measure, perhaps Sortino ratio. Uh, and then another way that I like to look is a consistency. So rather than just looking at the standardized year-to-date, 1 year, 3 year, 5 year, 10 year returns and ranks, which has a tendency to be, subject to end period bias. You might draw long-term conclusions about a manager, and those conclusions could be very distorted by how that manager did in the last 6 months or 12 months. I like looking at rolling period batting averages. So what percentage of rolling 3-year, 5-year, 10-year periods within the context of the entire track record did the manager wind up in the top quartile, second quartile, third and fourth quartile? So consistency is part of the ride, right? Just as much as downside capture. So if you can find managers with attractive upside downside that have delivered consistently well relative to peers over rolling 3 and 5-year periods. I don't look at 1 year because at 1 year, it's a lot of noise and very random
Yep.
anyway. If you're not prepared to own for, for really for 10 years, but I'll look at a minimum threshold of 3, 5, and then 10. Those are ways I like to seek out differentiated active managers.
That's fantastic. I love talking investment analytics here at Zephyr. That's what we're known for. And your exact those statistics you named, upside capture, downside capture, you protect the downside. That leaves more of your assets available to capture the upside, right? And that's what's important.
I was just reading a statistic from Charlie Bilello, which I thought was interesting. If you bought and held the S&P 500 since 1950, 92% of the time you were going down or climbing back to break even. Only 8% of the time were you reaching new highs. So, once you take a big drawdown, you waste so much of subsequent advancing markets, assuming you hold on, which many people don't. But if you had the discipline and tenacity to stay the course, you're wasting much of the next advance just climbing out of a hole you may have unintentionally dug for yourself simply by chasing the 1, 3, 5-year performance rate.
Yeah. Let's talk about that real quickly about you know big mistakes maybe investors make, such as not holding it long enough. What are you kind of mentioned giving up um the upside opportunities and digging yourself out of a hole, or is what other big mistakes are there? Not holding long enough, compounding growth, you lose that benefit.
Yeah, another great question, if I may say so. I will give you a couple of things, but there's another adage. I'm filled with market adages, but
I love it.
people tend to buy today what they wish they bought 10 years ago or 15 years ago. Right? So that's another way of saying people chase past performance and they don't think about forward-looking outlooks. Okay.
Yeah.
If you respect market cycles and mean regression, which I do, and I think most fiduciary focused FAs do as well, then you have to kind of think about the stuff that hasn't done as well over the last 10 years,
Yeah.
as much as you do think about the things that have done extremely well. So today that means looking at emerging markets, both fixed income and debt. It means looking at international and developed. It means looking at alternatives that have low correlations to the direction of the stock and bond markets. It means making sure that your fixed income is working as hard for you as possible, but balancing the credit and duration risk. So that to me is one of the most important things that people do. The other thing that's a common mistake, and we have a great marketing piece that's client approved on this called the myth of consistency. There's this view that managers that are great are always good. And we took a look at active managers that were in the top quartile of their Morningstar category for 10 years. We update this every quarter, so it's constantly changing. But we looked at the percentage of time those top quartile managers over 10 years found themselves in the bottom half, bottom quartile, third quartile over rolling 3 and 5-year periods. And it's shocking to most advisors how frequently managers that are great over time have the discipline to look wrong from time to time,
Yeah.
and willing to have the courage and the discipline and to trust the process to stick with their methodology through an extended period of lower peer rates. What looks like a reason to pull the trigger when you're going through it, oftentimes is then used as a statement of discipline by the manager after the fact. Those to me are some of the factors that I would think about in terms of that cause investor mistakes.
Yeah, that's it. I couldn't agree with you more on that, Barry. That you know, an investment style, if you're a value manager, it's been out of favor for a while. And I look at that, when researching different managers, are you still consistent to that style? You talk about consistent, maybe not consistent performance, but are you consistent in your style and your conviction, even when it's not in favor? Or are you chasing the flavor of the month, right? That's what is important. And you got to believe in it, right?
I'll give you a last one on this. Some advisors I find are reluctant to talk about what we refer to as the price of admission, right? Everybody wants to pursue decent returns over time. Many of us want to pursue inflation beating returns to protect our purchasing power over time. But, the old adage again, no pain, no gain, no risk, no reward. Uh, I would encourage advisors to go out of their way to share with people the frequency of market declines historically. So, the fact that the markets typically have an intra-year high to low drawdown of about 14% since 1950. I think that's a really important thing to go out of your way to share with them so that they're not shaken out during the next decline that occurs that looks like that. How frequently you have bear markets of 20% or more, 30% or more. They don't happen frequently, but they happen every 5 or 6 years on average. The more people understand this and understand the important benefits of pursuing compound growth over time, I think the more likely it is that they will tolerate the periodic volatility that is the ultimate price of admission for pursuing the returns they desperately need.
Barry, I think that's a great way of capping off this conversation. Great way to end it. And I agree more. It's amazing looking back and looking at these, you know, and corrections, these 10% corrections. It's like they almost happen every year, yet the market recovers. It's resilient, finishes the year up higher, in a lot of cases up 15, 20% recently. So thank you so much, Barry, for coming on the show. It was an honor and privilege. It was such a fun conversation, and you shared such great insight with our audience. I really appreciate it. Where can our audience get more information about Virtus Investment Partners?
Well, thanks, Ryan, and really appreciated the time with you as well. Our 800 number is 1-800-243-4361, or you can visit us at virtus.com. Thank you again.
Thank you so much, Barry. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Please be sure to like and subscribe to those channels and follow us on LinkedIn. Thank you very much and have a great rest of your week.
Take care.
Awesome.